coming this evening. My name is Matt Radtke. You've seen my brief bio there that Blair put up earlier, but basically I'm a computer science major from way back when, in the dark days before the internet. And I've been developing software on and off ever since then, with some brief stints in management as well. I started trading stocks and options in 2008, which, as you know, is a fabulous time to jump into the market, because I learned some really valuable lessons about position sizing. A couple of years after I started trading, I got interested in quantitative trading and took a swing trading college class from Larry Connors, and eventually ended up working for Connors Research. I've been doing that also on and off since about 2012. And finally, I am an independent AmiBroker consultant. So I basically help people get their strategies well defined, build AmiBroker code around it to backtest it, optimize it, refine it, etc. So that's who I am. Here's what we're going to talk about tonight. We're going to talk a little bit about quantified trading strategies in general, what we mean when we say that, and how we go about backtesting and optimizing those strategies. And then we're going to talk more specifically and spend most of our time on adaptive trading strategies. So we'll talk about how those are different than a regular quantified trading strategy, why we might want to do that, and then what process we would go through to develop a quantified adaptive trading strategy. And by the way, any questions you have, feel free to ask as we go along, or we'll also take time at the end to answer questions. But I'm happy to take detours and whatnot to address questions as we go if anything comes up. So quantified trading strategies. By my definition, a fully quantified trading strategies is one that has rules around everything that you would need to trade that strategy. So rules for finding your entry and exit signals, ranking your trade candidates, assuming that you might have more than you have capital to enter, when you enter trades and at what price, managing your trades as we go along, including scaling in, scaling out, things like that, and then finally exiting your trade, whether that's exit based on an indicator or an exit based on a stop loss or profit target or some other means. When we have that set of quantified rules, we can backtest those rules using a tool such as AmiBroker, which I assume all of you are familiar with at this point. Obviously, there are lots of other backtesting tools out there as well, including TradeStation, and you can backtest strategies at Quantopian and things like that. All of those tools have their own strengths and weaknesses. I personally think that AmiBroker is one of the best tools out there for backtesting. There are better tools for doing things like trade automation, but certainly for backtesting a portfolio of stocks, ETFs, futures, Forex, whatever, AmiBroker offers a lot of features, and it's also very fast. The guy who wrote AmiBroker, Tomasz Janesko, definitely has taken a lot of pride in really optimizing his code. So there's your little plug for AmiBroker as a platform. All right, in order to produce valid backtest results, when we're backtesting our quantified strategy, it's really important that you use a disciplined approach. So the first thing we already talked about, you need to define that set of rules for ranking, entering, exiting, and managing all of your trades. You also have to make sure that you're going to apply those rules consistently to all members of your trading universe as that universe existed at the time of the trade. And what I mean there is, if you have a strategy that is trading, for example, S&P 500 stocks, you do not want to take today's S&P 500 and backtest that strategy from 2001 through today, because you will have tremendous survivorship bias, or what some people call pre-inclusion bias, because right now the S&P 500 has all the stocks that survived 2008 and all the other years between 2001 and now. That's where using a good quality data source like Norgate, which has a product called Norgate Data Updater, NDU, which provides historical index constituency, that can be extremely important if indeed your trading strategy somehow centers around trading one of the indices. If it doesn't, then that's fine. If you're just saying, I'm going to trade all stocks, I don't care which index it belonged to, or even if it belonged to any index, in that case, you want to just make sure that you have delisted stocks included in your database. Because again, unless you're trading a very discrete universe, you still want to trade all those companies. You want to trade Bear Stearns, and you want to trade WorldCom and Enron, and all those big companies that used to look great and aren't around anymore. So that's what I mean by applying the rules consistently. And then finally, we want to manage our capital realistically. And what I mean here is, if you have a system that trades a lot, and you frequently have entries and exits in different symbols that occur on the same day, you don't want to write your back test in a way that would allow you to enter trades in the morning and exit other trades, freeing up your capital at the close of the day, right? Because then you're essentially overutilizing your capital, right? So you need to be careful about making sure that the order of events is correct, and also making sure that if you're virtually placing orders with your back test, that you're only placing as many orders as you could actually afford to take the trades. So lots of little things to watch out for in order to get good, accurate backtesting results. And we could spend lots of time talking about that. I'm sure some of you are already familiar with those challenges, and others, maybe this is a little bit newer. All right, when we define a set of rules for a quantified strategy, we typically don't know in advance which parameter values are going to generate the best performance. And even the term best performance is something that's up for discussion, right? Because what I consider the best performance of a strategy might be different than what you consider the best performance. But typically what we want to do is test lots of different values for our parameters to see which ones perform the best. And the example here is, if we have a system that looks for some set of setup conditions and then enters the next day on a limit order, we might want to test different limit percentages. So maybe we want to test 1% below today's close, or 2%, or 5%. And similar challenges would occur with all of our other strategy parameters. What AmiBroker allows you to do is run an optimization whereby you tell it which parameters you want to optimize over, and you give it a range of values for each one of those parameters. So maybe my limit order percentage would be 1% through 5% in increments of 1. And if I'm trading a mean reversion strategy, then maybe I'm requiring that on the setup day, my RSI 2 value be below something between 10 and 30 in increments of 5. What AmiBroker does during an optimization is it will go through and find every unique combination of parameters and run the backtest for that, and then at the end give you a summary of all the different parameter combinations, which we typically refer to as strategy variations. So if you hear people complain about backtesting, or especially optimization, the complaint is usually that you're just curve fitting. That if you look at a broad enough array of parameter values, you're bound to find at least one good one, unless you just have a totally rotten strategy, right? So, and that's valid. You do need to be careful not to over optimize a system, and you also should always reserve some of your data for doing an out of sample test, so that by whatever means you come to the conclusion that a particular strategy variation is the best, that you can use an out of sample data set and go back and test that again and say, okay, I thought that this strategy variation was the best. Now when I test it out of sample, does it still perform up to my expectations? Another thing that we can do, though, to avoid that optimization problem is to use adaptive trading strategies. And so that's what we're going to talk about next. Before I jump into that, any questions on what we mean when we talk about a quantified trading strategy, or backtesting, or optimization? Are all those concepts pretty clear to people?
Yeah, the group here is pretty solid, so I think we're good.
Okay, great. All right, so adaptive trading strategies. Typically when we develop a static quantified trading strategy, we somehow arrive at the conclusion that one particular set of parameters is our favorite, and that's the one we're going to trade in live trading going forward. The difference with an adaptive trading strategy is that it can change the parameter values, the thresholds basically that we're using, based on current market conditions or other factors. And I say other factors because I have clients that have built basically adaptive trading strategies that are not based on a market regime. They're based instead on the price of the stock that's being traded, for example, or a certain time period of the year if they're trading futures or things like that. But for tonight, we're going to kind of focus on this idea of a market regime. So the example here is, instead of having a fixed rule that says, a setup occurs when all these other things happen and the RSI2 is less than 10, we're going to allow that value of 10 to change depending on what kind of market we're in. So maybe we'd require that the RSI2 be less than 5 in bear markets and only require that it be less than 20 in bull markets, meaning that it would be easier to get into our trades in bull markets and harder to get in bear markets. The advantage of focusing on a single market regime at a time is that we then increase the likelihood that future performance of the strategy is going to more closely resemble the past behavior under similar market conditions. Because as you know, one of the challenges that you run into is, let's say we run our initial back test from 2001 through 2012, which is the example we're going to use later on as well. So we've had a couple of really tough bear markets in there, right? In 2001, 2002, and again in 2007 and 2008. We've had some tremendous bull market activity from the time we bottomed out in 2009, mostly through the present with a few exceptions. So we've had a nice variety of market conditions. But if you picked your strategy variations in 2012 and then started trading it or did your own sample testing, since 2012, we haven't had any bear market kind of activity, any significant bear market activity. So because we based our strategy parameter selection on that broad range of things, and then when we started our live trading at the end of 2012, we were no longer experiencing a broad range of market regimes. Our strategy may not have performed as we had wanted, and we'll see an example of that in a little while here. In order to do this, in order to say, well, I'm going to trade different strategy rules depending on the market regime, there's a couple of implied assumptions. The first one is you have a way to define your market regime, and that's very important in terms of how you do that. And then the other is that however you define your regimes, and you can have as many of these as you want. We'll go through an example tonight where we have 4. But however many you have, in order to make this meaningful, you need to have a sufficient number of trades, a sufficient amount of data, basically, that we can analyze for each different market regime. It doesn't do me any good to run a 10-year back test and then find out that one of my market regimes over that 10 years only had 7 trades. Like, well, who cares? I mean, basically, I'm saying that I've got a market regime that's either occurs so infrequently that I never get any trades, or something about the quality of my trading rules in that kind of environment prevents me from ever getting trades. But I certainly don't want to make any decisions about which parameters to select based on 7 trades over a 10-year backtest period. All right, so I'm going to kind of go through the steps that we would need to go through to define an adaptive trading strategy, and then we're going to go back and look at each of these in a little bit more detail. So the first thing we need to do is what we were just talking about. We need to define our market regimes. So you need to think about what sorts of market conditions would be pertinent to your trading system, and then come up with some sort of a quantified definition of what each of those how we would identify each of those market regimes. Obviously, we need some sort of a trading strategy to start with. So we start with a regular old quantified trading strategy that does not have any adaptive parameters. Then we're going to pick some baseline date range. And again, you don't want to take all of your available data and use it on this first part of the test, because we want to reserve some significant portion of your data to do an out of sample test when we're done to see if we've been successful or not. So using that baseline date range, and tonight we're going to use 2000 through 2012, we're going to basically optimize our strategy across a range of parameter values and that particular date range, and we're going to see how the strategy does. And specifically, we want to summarize the metrics of interest by market regime. So it's all well and good to say, well, my overall car compound annual return for 2000 through 2012 was 17%. But what I really want to know is, okay, so for this particular variation of the strategy, how much money did it make in a bear market? How much money did it make in a bull market? Et cetera. So we want to be able to tell for each one of our market regimes what the performance looked like. And you'll see that I've picked out some performance metrics that work for me. You may look at it and say, oh, well, boy, those are nice, but I would rather have these other summary metrics for each one of those different market regimes. And that's fine. If that's what you think gets you there in terms of being able to pick the best strategy variation for each regime, then creating metrics is typically easy. All right, so once we've done that, we've run our optimization over our base time period, we've summarized all our metrics by market type or market regime. We're going to somehow pick the best set of strategy parameters for each one of those market regimes. And again, best is something that's pretty individual to the trader, right? I'm going to use something pretty simple tonight and say my best is I want to make as much money as possible without too much pain. So I'm going to look for basically high compound annual return without excessive drawdowns. But you may have other things that you like to look at. Some people like to look at Sharpe ratios. Some people like to look at how volatile their returns were, things like that. So there are lots of things that we could throw into the mix there. Once we've selected our favorite strategy parameters for each market regime, we're going to build an adaptive strategy that basically changes our parameter values depending on what the current market type is. And note there that we may find that for certain types of strategies that there are no market, or for a certain market regime, there is no combination of strategy parameters that gives us acceptable performance. So we might say that in a very volatile bear market, we're just going to stop trading, and that's fine. That's sort of an extreme version of an adaptive strategy, right? Just turn everything off. So again, in our example tonight, that's not going to be the case, but if you were to go through this exercise yourself, you might definitely find that. Once we've built our adaptive strategy, which is going to pretty much use the same code that our initial strategy did, other than this concept of changing the threshold values for our parameters based on the market regime, we're going to test our new adaptive strategy over a new date range. So in the example we look at tonight, our base time frame is going to be 2000 through 2012, and then after we've created our adaptive strategy, we're going to retest it on the range 2013 through the end of 2017, just to keep it in whole years. And then finally, we're going to rerun the optimization of the original static strategy over that same date range. And that's so we can compare how did those variations do over this new time period versus how did our adaptive strategy do over that time period. And then finally, we're going to compare and see, did our efforts to make an adaptive strategy actually pan out? Did they offer some benefit to us? All right, so those 9 steps are summary of where we're going. So step number 1, defining market conditions. Obviously, the how you define a market regime is going to be highly dependent on how you trade, what instruments you trade, what time frame you trade in. You know, for people that trade on an end of day basis and do swing trading or trend following, they might typically look at the 200-day moving average of the S&P 500 index or the SPY ETF. People that are day trading probably don't care so much whether the SPY is above or below its 200-day moving average. Right? They're much more concerned with very granular price moves. In the examples we look at tonight, I've done something that I've used quite frequently, and this seems to work well for me for the types of strategies I trade. We're going to look at both a volatility component and a price component. And there's going to be basically 2 different volatility regimes and 2 different price regimes, which gives us a total of 4 different market types. So we'll see references to a volatile bear market, a quiet bear market, a volatile bull market, and a quiet bull market. And when we look at the spreadsheet, we'll see exactly how those are defined. All right, step 2 is to define our trading strategy. So the strategy that we're going to use tonight is a really simple mean reversion strategy, and its core indicator is RSI2. So here are the rules for the strategy. A setup occurs when the stock is a member of the S&P 500, and that means it's a member of the S&P 500 on that day. It's not necessarily currently, as of today, a member of the S&P 500. Average daily turnover for 21 days, or approximately 1 month of trading time, is greater than $1 million, and turnover is just the closing price times the volume. The RSI2 is going to have to be less than some threshold, and the thresholds I tested were 5 through 25 in increments of 5, and the RSI2 has to stay below that threshold for 1 day, 2 days, or 3 days. And I tested all those independently. I do require that the close of the stock that's being traded is greater than its 200-day moving average, and I require it to have some amount of historical volatility. So 100-day historical volatility has to be greater than 15, 25, or 35. So basically what we're looking for here are stocks that are essentially in an uptrend. They're above their 200-day moving average. They're reasonably volatile, and they've had some sort of a little pullback as evidenced by the RSI2. And they have to be a member of the S&P 500. So that's our simple setup. When all of those things are true, we're going to place a limit order basically on the day after the setup occurs, and we're going to use a limit percentage of 1, 2, 4, or 6% below the close of the setup day. If we have more setups than we have capital available to actually take new trades, we will rank the trade candidates by the highest historical volatility. And we're going to use very simple position sizing. Up to 10 open positions, and each position will be allocated 10% of our current equity. We have only one way to get out of the trade, and that's to sell when the RSI2 rises back above some threshold, and the thresholds that I tested were 60, 70, and 80. So basically we're buying on the pullback and we're selling into strength. Very, very basic mean reversion. All right, so in order to generate our data that we want to look at for each of the market regimes, I coded up this strategy and I ran an AmiBroker optimization, and I used the date range January 1st, 2000 through December 31st, 2012. And we are going to take a look at those in a spreadsheet, if I can. Let's see. Okay, so can you guys see my Excel spreadsheet?
Yes, it's fine.
Okay, great. So this is kind of standard format for me in terms of defining strategy rules. So just a little bit of information at the top in terms of the strategy name and what data set we're using and watch lists and things like that. But starting on line 10, we'll see our market regime rules. So as I mentioned earlier, we have 2 different price regimes and 2 different volatility regimes. So for the price, we're calling it a bull market if the 5-day moving average of the S&P 500 of SPX is above the 252-day or 1-year moving average. The reason for using MA5 on the left side there is just to avoid spiky behavior and smooth things out a little bit. One thing that we don't want with our market regime is for it to be whipsawing back and forth between different regimes too quickly, because that just makes it very difficult to really figure out which set of parameters you should be using. And so a bear market is when the 5-day moving average of the SPX is below its 252-day moving average. In terms of the volatility, I'm using VIX, so I've got a view of implied volatility. And again, we're using the 5-day moving average of VIX to smooth things out a little bit. But in this case, we're looking at all of the VIX MA5 values for the past 252 days, or the past 1 year. And if the current value of the VIX MA5 is in the bottom 35th percentile or below the 35th percentile, we're going to call that a quiet volatility environment. And if it's above the 35th percentile, so if it's in the top 2/3 anywhere, we're going to call it a volatility environment. So we combine those 2 things with each other, and we have quiet bull, quiet bear, and volatile bull and volatile bear. The strategy rules we won't review again because we just talked about all those, but those are here in rows 22 through 37. And then I'm charging 1 cent per share commissions, and if there's cash left over in the account, we're using the T-bill rate to generate a little interest on that cash, much as a money market would in a regular trading account. So here are the results from 2000 through 2012. And you can see all the standard AmiBroker columns here and all the different metrics it generates. I've hidden some of them because these are the ones that I tend to focus on the most. So one thing you'll notice right away is right now these results are sorted by highest compound annual return. And I put in some conditional formatting to format in green the top 10 results by car of all these variations. So for example, our top variation is variation number 127. It had a compound annual return of 19.65%. And when we go over here to the other side, we can see the parameters that got us there. So we had an entry limit of 4%. We use an exit of RSI2 greater than 70. We use an RSI entry threshold of 5. It had to be below that threshold for 1 day, and it had to have a 100-day historical volatility of at least 25. So from 2000 to 2012, that was the best compound annual return. Okay, so that's nice, but I said I didn't want to suffer too much pain either. So I also ranked all of the CAR over MBD numbers, and if we were to resort by that column, you'd see that all those top ones are green, so all the top CAR over MBD values are green. And there's only 2 cases where we got green in both columns. So in other words, these 2 variations, variation number 136 and variation number 46, were cases where the compound annual return was in the top 10 and the CAR over MBD was also in the top 10. So now I'm feeling like, okay, those might be pretty good variations for me to trade. I have to somehow choose between those, so I can either choose a little bit higher CAR with higher drawdown, or I can choose just a little bit lower CAR and a little bit lower drawdown. And I'm going to choose this one, the one that has CAR over MBD of 1.44, and I've highlighted that one in yellow. So that's variation number 46 in our strategy. If we were, sitting home on New Year's Eve of 2012, working on our trading strategies, instead of out partying and welcoming in the new year. This might be the strategy variation that we decide we're going to start trading in 2013, right? If we had ignored the advice to do some out sample testing and we were just taking on our in sample testing, we'd say, yeah, this one looks pretty good to me. It's got a nice CAR, it's got a reasonable CAR over MBE, everything looks good. All right, so in some of these columns that are hidden, we have metrics for each of the different market regimes. So the first thing you'll see here in the first set of 4 columns is how many days was this market regime in effect for over our 13-year in-sample testing period from 2000 through the end of 2012. So we can see that we had about 1,000 days that were volatile bear, 247 that were quiet bear, 714 that were volatile bull, and 1,300 that were quiet bull. Clearly, those are not evenly distributed. But if you think about it a little bit, usually when we're in a bear market, prices tend to be more volatile. So it's not surprising that a quiet bear market doesn't occur as often as the other market regimes. In terms of the overall balance between bear and bull, we have about 2,000 bull days and only about 1,250 bear days. Again, yeah, that doesn't seem unreasonable, right? We know that since 2000, the market has been going up more than it's been going down in terms of number of days. So that seems like it's probably a reasonable representation of how most of us would interpret bull and bear markets over that time period. So that's a good sanity check. Then we have how many trades were generated in each of those different market regimes, and then just doing the division to show how many trades per day on average we were seeing for each of the 4 market regimes. The next block is rather large, so there's a lot of metrics that I calculated for each one of those 4 regimes. So we have for each market regime the total P&L in dollars. We have the average P&L, so the average P&L per trade as a percentage for each of the 4 regimes. Then we have the cumulative percent P&L per regime, and we'll talk in a minute about why I included that and why that's useful. And then the win rate, so the percentage of winners for each one of those regimes. And then also, for those that might be interested just in the winning side, we also, in addition to having the average percent P&L, we have the average percent gain just on the winning trades. That's not going to come into tonight's discussion, but sometimes that can be helpful. All right, so we have all those metrics, and we'll come back to those in a minute. And then finally, that last button I clicked on said annual results. So this shows us all of the interesting numbers for each of the years in our backtest. And that's just something I sort of include by habit. It's not part of selecting an adaptive strategy for tonight, but if you decide to take a look at the spreadsheet yourself, you'll see that that is in there. All right, so great. We have all those metrics, and we're going to go back to our results by market regime. Expand that. What we see over here to the right is the way that we're going to pick our favorite parameters for each of the different 4 market regimes. So the yellow column corresponds to the yellow row. So this is variation 46. These are the parameters we would have ended up with had we just chosen on December 31st of 2012 which variation of the strategy to pick, and we weren't going down the adaptive road. We would have just said, great, these parameters have done well for 13 years. Of course, they're going to do well for another 5 years. But for each of these other markets, so for the volatile bull, volatile bear, quiet bear, volatile bull, and quiet bull, I first looked for the maximum cumulative percent P&L, which is just the average P&L times the number of trades. You would think that this would be pretty analogous to the total dollars of profit but in fact, it's a little bit different because when we look at total dollars of profit, trades that are later in the back test are going to, assuming we have a successful strategy, trades that are later in the back test are going to be larger on a dollar basis because we're continually using 10% of our equity. And if our equity is growing, that means our position sizes get larger and larger as time goes on. So if we used the total P&L back here, the dollars of P&L, that is basically weighting our results towards more recent performance, which in some cases you might want to do. I decided that I would rather use the cumulative P&L, so the average P&L times the number of trades, so that basically the performance of all my trades was weighted equally. And hopefully that makes sense. So this first row finds the maximum cumulative percent P&L for each of my 4 market regimes. And then we just use the magic of Excel to say, okay, so which row is that in using the index command or the match command. This is just repeated data from what we talked about earlier in terms of the days in each market type. But then this is where the important stuff is. This is our parameter selection for each of those different market regimes. So when we're in volatile bear, if we want to pick the variation that had the best cumulative percent P&L over that 13-year time period, we would use an RSI entry threshold of 25, below the threshold for 2 days. We need minimum HV of 25, and we want to use a 4% limit order. And we can see that as we go across, some of the parameters don't change. So it looks like for all of these, 2 days below the threshold was the best number, which of course is not the same as what we would have gotten if we'd chosen variation 46, but it is consistent across all of these. Likewise, the minimum HV value of 25 is consistent across all those. The entry limits definitely differ. So as we go from a more volatile bear market to less volatile to getting into a bull market and finally a nice quiet bull market, we use a lower and lower entry limit percentage. In other words, it's easier and easier to get into trades. If the whole market is going up, why not jump into trades sooner, right? So that kind of makes some intuitive sense. The RSI entry thresholds, maybe not as intuitive. That in quiet bear and volatile bull markets, we use a much lower entry threshold, and in the very volatile bear markets or the very quiet bull markets, we're using a higher threshold. But that's, based on picking from these numbers, which is what's driving everything. These are the set of parameters that we've selected. All right. So we've gone through this step where we've done our optimization and we've picked our parameters. So let's continue on here with our steps. All right, so these are the things that we just talked about. We're focusing on compound annual return, max drawdown, CAR over MBD, and we've reviewed the overall best variations as well as the variations that performed best in each market regime using our current definition of what best means. And there's our little table that we were just looking at that has selected all of our favorite parameters for us. Right, so that was step 5, picking the best parameters for each market type. All right, so when we go to code this as a backtest, when we're creating an adaptive version of the strategy, there's some things to keep in mind. First, all of the parameters, whether those are scaling rules, stops, profit targets, exit types, limit entries, RSI thresholds, all of those are determined by the market regime that was in effect on the setup day. So you need to be a little bit careful if you're writing this in AmiBroker or presumably in any other platform to make sure that you remember the market regime on the entry day. For example, when you're determining what to use as your RSI threshold for exit. If you have only very short trades, that is less and your market regime doesn't change too frequently, that's less likely to be a problem because chances are good that you'll get into and out of the trade in the same market regime. If you were writing a trend following strategy that stays in trades for weeks or even months, it is much more likely that you will enter your trade in one market regime and exit in another. So you just want to make sure you're cognizant of that and you're doing your back testing the way you intend to trade. The way that these metrics are set up, the way that I've done them in my code, everything is driven by the market regime on the setup day. You could clearly write that so that you look at the market regime on the setup or the entry day for all your entry parameters, and then you change the exit parameters based on the market regime that's in effect when it's time to exit the trade. There's nothing wrong with doing that. It's just not the way that I wrote this particular test. Also note that if you're using an adaptive system, an adaptive trading strategy, you probably want to have some sort of a good automated scan that finds your trading signals for you. That's probably true of any quantified trading strategy, but it's especially true when you're changing your parameters based on what the market type is, because if you're not careful, if you are somehow manually finding your trades, or maybe you're manually changing your backtesting code, your signal generation code, and you're changing the parameters manually to match the market regime, well, what happens if you don't notice that the market regime changed last night? Now you're finding a set of signals that don't correspond to the market regime that they really should. All right, so we found all of our favorite parameters. We've built them into a new adaptive version of our trading strategy, and then we're going to go back and run both that adaptive strategy and the original strategy as an optimization over that a new date range. And our new date range in this particular case is going to be January 1st, 2013 through the end of 2017. And I stopped there simply because I wanted to have full years in my backtest report and not mess around with a partial year for 2018. All right, so let's take a look at how things turned out. So back to our spreadsheet. Here's our 2000 through 2012 results. Recall that variation 46 was the one that we picked because it had a top 10 CAR and it also had a top 10 CAR over MDD. And we said that that was our primary criteria for finding a variation to trade. So when we go to forward test that into 2013 through 2017, we see a brand new set of results. The variation numbers over here are going to be identical to the first case because it's the same combinations of possible parameter values. And I have plugged in what the compound annual return from 2000 through 2012 was, as well as the CAR over MDD. So if we take these results from 2013 through 2017, and we look at all the variations that had the best compound annual return, you'll see that there are no green squares, no green cells from the 2000 through 2012 results. And in fact, if we start, so there's about 270 variations of this strategy. If we start scrolling down, the first time we find something that was in the top 10 in the 2000 through 2012 date range, is down here on row 48. So basically there were we have one row for the header, so there were 46 better variations that occurred in our new time period. If we keep scrolling down, we see a few more green cells in column AN, the 2000 to 2012 line. But we have to keep going down and down. And finally down here at row 149, we find good old variation 46. So this is the one that we decided on New Year's Eve 2012 that we were going to trade. You know, it had made almost 18% a year in our initial backtesting period, but from 2013 to 2017, it made 2.5%. Probably not what we were hoping for, right? So I don't know about you guys, but I've certainly had this happen in live trading where I thought that I picked a great strategy variation to trade, and sure enough, as no matter how much testing I do, as soon as I start trading it, the performance goes to hell, right? And clearly that's what happened with our variation 46, is that it just didn't do well starting in 2013 and going through the end of 2017. So our question is, so if we go back up to the top of our list, here are all of our best variations in the 2013 to 2017. The million-dollar question is, how did our adaptive strategy do? So over here, if I include our adaptive strategy, we'll see that our adaptive strategy that we picked out just based on our little table over here, right? We use these parameter values in the 2013 to 2017. So basically our out of sample, walk forward, whatever you want to call it, our adaptive strategy made 16%. And it had a CAR over MDD of 1.48. It would be lovely if I could tell you that it was at the very top of the list. It had, bigger returns and smaller drawdowns than any other strategy any other strategy variation that occurred in the 2013 to 17 timeframe. That's not the case, right? We could have, if we had chosen variation 182, we could have achieved a 22% rate of return over that 5-year period. But the question is, was there anything in the 2000 through 2012 time period that would have let us pick that variation 182? And I would contend that there is not. Whereas with the adaptive, we went through, a very reasonable process that any of you could repeat, and we ended up with, strategy performance that was within the top 10 of these 270 different variations, and also compound annual return that was only exceeded, or I'm sorry, CAR over MDD that was only exceeded by one other variation that's in that top 10. So all in all, we ended up picking out a pretty good variation to trade by using our adaptive parameters. All right, so back to our slides here. That's just a slide of the same Excel spreadsheet we're just looking at and how we would compare those. So, as I just mentioned, this isn't magic. It doesn't guarantee you that you can achieve better performance, however you define that. And for tonight, we've defined better performance as higher CAR without excessive drawdowns. You won't necessarily achieve the maximum possible best performance, but it will certainly move you closer to the top of the range than if you had picked by some other method, or at least that's been my experience with a number of different strategies. It does seem to me that how you define your market regime is extremely important. So I've done this exercise where I've experimented with different definitions of market regime and having 6 instead of 4, or even 9 instead of 4. And some of those have just failed miserably. And one of the reasons, I believe one of the reasons that they don't do well is something I mentioned earlier. If you're moving in and out of different regimes too often, basically you don't really have a good idea of what set of strategy parameters in your adaptive strategy you should be trading. If it's bull volatile today, and then it's bull quiet tomorrow, and the next day, and then the day after that we go to bear quiet, and then the next day we're back to bull volatile. Who knows which parameters you should be trading, right? The day that your setup occurred is a different market regime than the day that you entered, which is a different market regime than the day that you exited, and it's just too hard to tell. So my advice would be to start out with fewer market regimes rather than more, and also to really look at them and maybe even put them on a chart so you can see how quickly they're changing. You don't really want to see lots of changes back and forth between different regimes. All right, so that's a lot of me talking and very little of you all talking. Can I answer any questions about that whole process?
Well, I know I got the benefit of reading your slides before, and I thought it looks really good. Did your spreadsheet also show how the adaptive system would have compared back to your 2002 or 2012 presentation time frame?
It did not. In a way, that's cheating, right? Because if we go back to 2000 through 2012, and that's how we selected our parameters, was by choosing the best performance in each market regime, then presumably if we go back and test now with those best parameters, we're going to do really well. We could go through that exercise just to see that that's the case, but it would be kind of like saying if we didn't have an adaptive strategy and we just chose these variation 46 parameters and then retested over the same time period, well, we know we're going to get good performance, right? We already determined that. So I feel like even with the specific market regimes, we've also kind of already determined that these particular strategy variations performed well in each of those 4 market regimes over the time period 2000 through 2012. Therefore, you don't learn a lot by retesting over that same time period.
Okay, granted. Any other questions here, guys?
Maybe just a general question. Was there a way?
Pass the mic here.
Hi, Matt. Great presentation. Just had a quick question about, I guess, identifying the type of market regime when you're in that type of market regime. So if you're looking at a fully mechanical system, is there a way that you can identify those market regimes while they're either transitioning from one regime to the other, or identifying that market regime while that regime is in play?
I'm not sure if I completely understand the question, but yes, you will definitely have times when, especially in live trading, you suspect that you're transitioning from one regime to another, right? But if you've gone through this whole exercise, you've defined a very specific set of rules that tell you what market regime you're in. So if we've said we're in a quiet bull market if the volatility is in the bottom third of its range and the price action is in the upper part of its range, even though your gut may be telling you, ooh, there's a lot of stuff going on, I'm pretty sure volatility is going to go up and we're going to go from quiet bull to volatile bull at least, and maybe even into bear. That's great. You can thank your gut for the information, but your rules still say, according to the data we have today, we're in this quiet bull market, and that's how we're going to trade it.
Sorry, could you please expand how do you define the market condition, the market regime?
Define the market what?
The market regime. How do you define it? Going back to the slide where you define it.
So my definition for this exercise is I define my market regimes like this, and we're going back to the spreadsheet here. So I said that for the price, we're going to differentiate between bull and bear based on whether the 5-day moving average is above or below the 252-day moving average. So basically, prices over the last week compared to prices over the last year. And then for volatility, I used the VIX. I'm looking at implied volatility rather than historical volatility. And I'm looking at, again, a 5-day moving average. I'm saying if the 5-day moving average is in the bottom 35th percentile, so roughly the bottom third of the past 252 days or 1 year, if we're in that bottom third of the volatility, then we're going to call it quiet. And if we're in the top 2/3, we're going to call it volatile. Right, so that's my definition for this test. you may have different ways of defining what a market regime looks like depending on what sorts of systems you trade, what markets you trade, etc. I think I mentioned at the beginning that I've got some clients that trade futures contracts, and they very definitely look at seasonality type things, right? So their market regimes aren't so much about bull or bear. It's, well, is it springtime or is it the middle of the year or is it winter? Not necessarily corresponding exactly to the four seasons that we all think of, but something similar to that.
Okay, you can go more precise on the moving average because 5 to 52 is a lot of variance there. You can go to 18 moving average or 30 days moving average, something like that.
Right. So whatever you feel like works for you. I used a 5-day moving average as my faster moving average because I want it to be responsive. I just don't want it to be spiky. Right. So if I used a 30-day moving average for my faster moving average, then it's going to take a lot longer for me to change from bull to bear, right? Because that 30-day moving average will move more slowly. And on the other side, my slow moving average, I use the year because that seems like a reasonable look back period given the time frames that I trade in. Anything more than a year, I don't care so much. And if I make it too short, then I get into the problem of my market regime changing too quickly.
Okay, thank you.
Hi, Matt. This is Marcel Elvers. You did some work for us last winter, and I certainly would recommend.
Yeah, I thought I recognized your voice, Marcel. How's it going?
I certainly would recommend to anybody if they need any work or help with AmiBroker to hire you. And Larry is a part of this group too, but he's not here tonight. It's an excellent presentation. But my question is, for the limit orders, did you have to resort, if you used AmiBroker, would you resort to using the custom backtest for that?
Absolutely. And that comes back to that, managing your capital correctly, as we talked about early on in the presentation. So the issue that Marcel is referring to is when you run a backtest with limit orders, you basically, AmiBroker's default behavior would be to only rank the trades that are actual entries. But that's not realistic, right? I can't tell on Monday night which trades will actually enter on Tuesday and say, well, I have room to take 3 more trades and AmiBroker is going to take the 3 that actually got filled. So what I really want to do is say, well, I'm going to place 3 orders. I'm going to take my 3 top ranked setups and maybe those will get filled and maybe they won't, but I can only afford to take 3, I can only afford to place 3 orders. My broker will only allow that. So in order to simulate that in AmiBroker, we need a custom backtest.
Okay, thank you.
Yep. I see that there are a few questions online from Dave as well, so I can answer some of those. His first question was, what are your thoughts on using stops and the most effective stop types for mean reversion strategies? The answer to that is, I think that a lot of people are more comfortable trading with stops, but pretty much every mean reversion strategy that I've tested, stops do not help your performance. Or put it this way, they very seldom help your performance. And the reason for that is, when you're trading mean reversion, you're typically looking for some sort of a dip or a pullback, and you get into the trade and you hope for the bounce. Most of us aren't able to get in exactly at the bottom on that pullback. So if you get into your trade at all too early, it's likely, even if you're right and the stock is about to bounce, if you have your stop set reasonably tight, you're likely to get stopped out before the price bounces. So you'll never realize the benefit of the mean reversion. If you don't set your stops very tightly, then what's the point, right? Because these are quick little mean reversion trades that usually don't last more than a few days or maybe a week. So if you set your stop 10% away from your entry point, your stop's probably hardly ever going to get hit. So, can you put in a stop further away? just sort of as a catastrophic stop sort of thing, sure. But that's not going to happen very often. And my experience is it usually doesn't have much positive effect on your overall performance. Kind of best case with stops is that it doesn't hurt your performance too much when you're trading mean reversion. Now, trend following, totally different story, but Dave asked specifically about mean reversion. Dave's second question was, were your spreadsheet metrics and the main headings created using a custom backtest procedure script? The answer is yes, absolutely. So if we go back to these, we go back to our spreadsheet, everything up through basically losers, average, bars held, those are all, everything to the left of there are standard AmiBroker metrics. And you can see based on my column headings, it goes from A to D to X to Y to AA, etc. I've hidden some columns for metrics that I didn't want to focus on tonight. But there are lots of other standard metrics that AmiBroker generates. Everything from AL to the right are things that I generated myself inside my custom backtest. Now, some of them, like Maxis Drawdown and CAR over MDD, I just grabbed AmiBroker's values for those. So those are repeats of normal AmiBroker metrics that I just like to group together in the order that I prefer for convenience. And then there's other ones that I calculate completely on my own. So, for example, standard deviation of annual returns and Sharpe ratio and the percentage of months with positive and negative returns. All of those are things that I calculated myself in my CPT. Number 3 from Dave was, what are your thoughts on removing position sizing and using fixed position sizing as Bandy does when doing analysis? It seems as though your metrics used compound results to optimize. Number 1, I have a ton of respect for Howard Bandy. If you guys have not read his books, I would highly recommend them. And yes, it does, Dave, make sense to use some sort of fixed position sizing when you're doing that initial analysis. The reason I didn't do that here was because a lot of people can really relate to compounding annual return, right? I mean, that's one thing that almost everybody will look at with their live trading portfolio is, what's my annual rate of return? So I wanted to have that metric as part of this exercise, and also to see how it changed then. We took a variation that had a very nice CAR in the 2000 through 2012 timeframe, and a not very impressive one in the 2013 to 2017 timeframe. But those conveniences from the perspective of doing a presentation aside, yes, I can see how in a lot of cases it would make sense to use the fixed position sizing. And that, in fact, would have worked around the problem that we had when we were looking at the metrics on a market regime basis. If you remember, we were looking at this cumulative percent P&L, and I said the reason I wanted to do that was to take out the effects of position sizing. So that very much goes back to what Howard Bandy was saying. Dave's fourth question, when a system falls apart in live trading, is that an issue with stationarity? I'm going to take a pass on that one, because stationarity is a concept I've run into in Howard's books, but it doesn't necessarily make a lot of intuitive sense to me, so I'm not going to answer that because I'm not sure that I would answer it correctly.
Okay, JB?
Hello, JB here. Just a question of how you make sure you can avoid over-tuning, over-optimizing. What will be the minimum number of trades per market type that you are trading? And did you ever use 2D optimization feature that AmiBroker has in order to see what if your best optimization is just a spike, a random spike into the result?
So regardless of whether we're talking about market regime or not, some things that I look at when I'm doing optimizations to make sure that I'm not over optimizing is number one, I'll test a range of parameters, but I won't make those too granular. So for example, for my entry RSI threshold, you saw me test values of 5, 10, 15, 20, 25, maybe 30. I did not test in increments of 1 because I think it's silly to come up with a variation. You say, my RSI threshold is going to be 17. That's the one that turned out the best. You know, that is a very, very specific number for an oscillator that goes from 0 to 100. You know, likewise with limit entries. You know, I think whole percentages, maybe half percentages, depending on what you're trading, that makes sense. Looking at every 1/10 of a percent, you're just increasing your chances that you got lucky with a particular value, and like you said, you picked out that spike in the optimization results. If you kind of envision your optimization results as some sort of a 3D graph, you don't want to see lots of little spikes, or you don't want to pick one of those little spikes. You can also do that sort of analysis just by looking at your optimization results and focusing on one parameter at a time. So let's keep talking about our RSI2 entry threshold. We would expect that if we held all the other parameters constant, that what we would want to see, or what we would probably expect to see, is as the RSI entry threshold gets lower and lower, we should obviously see fewer and fewer trades, right? Because it's harder and harder to get down to that threshold. And we would hope that as we got those deeper pullbacks, that we would see higher average percent P&L, for example, and we would see sort of a progression of those values. If you're not seeing a progression, as your parameter values are progressing, if you're not seeing a similar progression of the results, and I don't mean an exact one-to-one linear progression, but something similar, then something is probably wrong, right? If you say, well, RSI 30, I got an average of 2% average P&L, and 25, I got 2.5%, 20, I got 9%, and then 15, I got 3%. I go, wait. Go back to that 9% average P&L. How did that occur in the middle of the RSI progression? That doesn't make sense. I think that somehow with that particular parameter, you got lucky on one trade or a couple trades, and it skewed your results. Right? So that's definitely something to look at. Another thing in terms of looking at your results being skewed is to say, okay, I've gone through, and all my optimization results seem to make logical sense. I can tell a story about why my number of trades goes up when this parameter changes, and I can tell a story about why my average P&L goes down when that parameter changes. Once you've picked your favorite variation or a handful of favorite variations, it makes sense to actually go into the trade list and say, okay, so now I've got my variation 46. I'm going to run that from 2000 through 2012, and I'm going to look at the outliers. I'm going to look at the trades that were the biggest winners and the biggest losers and see if some of those are so extreme that they skewed my overall results. I'm going to look at the trades that were held for the longest and the shortest periods of time and make sure that I didn't accidentally hold on to a trade because I forgot to exit when it was delisted, and this is a mean reversion system, and I entered a trade in 2002 and I didn't exit it until the end of the test. It was a 10-year mean reversion trade. Wrong. Right, so looking for those kind of anomalies and making sure that you haven't messed up in your code also will help make sure that you didn't overfit. And then finally, just that exercise of going through an out-of-sample test period, I think is, mandatory. If you're picking a strategy variation to trade, whether it's adaptive or not, picking something based on only in-sample testing is just begging to lose money when you go to trade it live.
All right, Matt, looks like Dave gave us another question.
Okay, I'm scrolling back up here. Okay. Does this adaptive approach bring in the curse of dimensionality, i.e. too many parameters for the amount of data? So Dave, that's a good point. this strategy intentionally only had a small handful of rules, but I think just like having parameter values that are too granular can easily lead to overfitting, having too many different parameters can lead to that same problem, right? So if instead of 5 rules, we had 20 different rules that we need satisfied for our setup condition, and we can turn the knob on all 25 of those, and every one of those 25 different parameters has 3 to 5 different values, blah blah blah, and we do our optimization, and there's 500,000 different strategy variations. You don't want to see that many different strategy variations because you're probably just asking to overfit, and it becomes harder to go through that exercise that we just talked about to say, do I see logical progressions when I look at each of my parameters in isolation? So yes, I would agree that having a strategy that's too complex, whether you're going the adaptive route or not, is usually not a good thing. Having that really complex strategy is just asking to overfit your data.
All right, Matt. Well, I think that was fantastic. Appreciate you taking the time to spend with us. Is there any other questions online or in here, guys?
I just want to ask one question. I have a question. How do you smoothen the earnings spikes?
So the data that I test with the most is from a company called Norgate, which is based in Australia, and they do data for the Australian stock market and the U.S. stock market, end of day data only. And there's a lot of things that I would recommend about them as a data provider. But one thing that they don't provide is historical earnings dates. There's historical ex-dividend dates, but not historical earnings dates. So number one, I don't have the data to do that kind of testing. Number two, most of the strategies that I trade aren't very much affected by earnings anyway, other than occasionally getting an entry signal because the stock took a dive on the day after earnings, right? And that looks like a pullback. And if you just test the strategy and say, okay, I'm just going to pretend that I'm totally ignorant of earnings dates, and the strategy still performs well, then I'd say you've got a successful strategy. If it doesn't perform well and you do some analysis and find out that the reason your strategy is not performing very well is because it suffers around earnings, then maybe you need to find a way to incorporate that into your strategy. So the last slide I just put up there, Blair will make the PowerPoint presentation to anybody who wants it. I did send him the actual PowerPoint, so I would just ask that you respect that and not distribute it or modify it and reuse it on your own. But the last slide there has my contact information. So if you do have any follow-up questions or want to discuss any of this, feel free to shoot me an email, or there's a contact form on my website. But I'm happy to follow up with anybody who's interested.